Today, we are diving deep into some pretty big news. The retirement of a key player at the SEC, Cicely LaMothe. Her departure really does mark the end of an era. And it's an era that has been absolutely critical in shaping the SEC's evolving, and let's be honest, often controversial stance on cryptocurrency.
All right, so here's our game plan. We're going to start with Lamont's legacy, then get into the pretty explosive allegations of a crypto choke point. After that, we'll flip the script and look at a totally different take on the SEC's recent history, break down the actual crypto disclosure rules her team put out, and finally try to figure out what all this means for the future of regulation.
So, first things first, who exactly is Cicely LaMothe? And why is her retirement from the SEC such a big deal for everyone in the crypto space?
I mean, think about it. For almost a quarter century, LaMothe has been a fixture at the SEC. She's held a bunch of senior leadership jobs and even stepped up as the acting director of her division back in 2021. That put her right at the center of the action during a really pivotal time for digital assets. Her boss, the director of the division, had nothing but praise for her passion and her focus on the SEC's #1 job, protecting investors. And let's face it, in a world as complex and crazy fast as crypto, that mission of giving people clear information has never been more important or, frankly, more difficult.
Now, this is where things get really intense. Lamothe's time in a leadership role happened to coincide with a period of heated, and I mean heated, debate over crypto regulation. And this includes some very serious claims of a targeted, government-wide squeeze on the whole industry.
A report that came out of the House Financial Services Committee recently did not pull any punches. It basically alleges that federal regulators, the SEC included, were all part of a coordinated campaign. They even gave it a name, Operation Chokepoint 2.0, designed to cut the crypto industry off at the knees by severing its ties to the traditional banking system.
So, a huge part of this alleged strategy was something called regulation by enforcement. And critics say this approach creates just a ton of uncertainty. Instead of writing a clear rulebook that everyone can follow, the agency just picks a few companies, makes an example out of them, and leaves everybody else guessing where the boundaries are. It's like playing a game where you only find out the rules after you break one.
The committee report really lays out the whole playbook. It says the SEC deliberately avoided making clear rules, choosing instead to launch these targeted lawsuits. It points to things like Staff Accounting Bulletin 121, a rule that basically made it a nightmare for banks to hold crypto for their clients. And the end result, they claim, banks started dropping crypto companies and a lot of top-tier innovators just packed up and moved their jobs and their businesses overseas.
But, there are always two sides to every story. And there's a completely opposite narrative about what was going on at the SEC, which we've got to look at next. In a letter to that very same House committee, Ranking Member Maxine Waters paints a very different picture. She argues that the subsequent administration politicized the SEC in its own way by dodging the public rulemaking process and using these informal staff statements to set policy. This, she says, is a huge problem because it weakens investor protections by basically cutting the public out of the conversation. So what we've got here are two fundamentally different stories about the SEC's actions. On one hand, you have the narrative of aggressive, targeted government overreach that choked crypto innovation, and on the other, you have the story of a dangerous, deregulatory agenda that weakened market oversight and put everyday investors in harm's way. So with all this political drama swirling around, you might be asking, okay, what was actually happening on the ground? Well, LaMothe's division was the one writing the actual guidance for crypto companies that were just trying to follow the rules in this super confusing environment. In April of 2022, her division put out a really critical piece of guidance. Now, this wasn't about creating brand new laws out of thin air. It was about clarifying how the existing securities disclosure laws, some of which are decades old, should apply to this brand new world of crypto assets. For many in the space, this was the rule book they'd been asking for. And the guidance really boils down to four main things. If you're launching a crypto project, the SEC wants you to 1. Clearly describe your business. 2. Be totally upfront about all the unique risks involved. 3. Get into the nitty-gritty of the technical specifics of your crypto asset. And 4. Tell everyone who is actually running the show. And when you dig into the details,
Wow. The level of information they're asking for is pretty incredible. The SEC wants to know everything: your development timeline, your consensus mechanism, your governance model, and exactly how you plan on making money. It's safe to say the era of vague white papers was officially over. This is where you can really see the SEC grappling with what makes crypto so different. Companies were told they had to disclose everything, from the obvious stuff like price swings and cybersecurity to more crypto-native risks, like the chance of a network fork or potential problems with third-party wallet providers. Now, all of this back and forth, all this debate and policy making, well, it wasn't just happening in a vacuum. It had a real human cost, not just for the market, but for the people working inside the SEC itself. This constant push and pull wasn't just a series of headlines. It created this, well, regulatory whiplash is the perfect term for it. And it created a really challenging work environment that had real-world consequences for the SEC's own staff, leading a lot of experienced people to just head for the door. And we're not just talking about a few people leaving. A 2023 report from the SEC's own Inspector General, man, it puts some hard numbers to this problem. Just look at this chart. In fiscal year 2023, the average attrition rate for the whole agency was about 7.5%. But in the key rulemaking divisions, like corporation finance, where LaMothe worked, it was a staggering 18.2%. And in investment management, it was a full 25%. And this brain drain became a huge concern for lawmakers. In that same letter, Representative Waters warned about the mass exodus of senior staff and started asking a very tough question. Does the SEC even have the people it needs anymore to do its job and protect investors? And that leaves us with the million-dollar question, doesn't it? With seasoned experts like Cicely LaMothe leaving, with staff attrition rates through the roof, and with all this intense political pressure coming from every direction, what's the path forward? How can the U.S. possibly create a clear, stable set of rules that somehow manages to both protect investors and let this new technology flourish? That is the challenge ahead. Hey, if this breakdown helped you connect some of the dots, help us keep making sense of this crazy space by hitting that like button and subscribing to Crypto Explorer 24/7. Thanks so much for watching. So let's talk about 2025. It was supposed to be the year for crypto, right? We were seeing these insane, record-breaking highs, and everyone was feeling optimistic. And then, bam. The whole thing just flipped on its head in the last few months. The market took a massive dive, and it left everyone scrambling, asking the big question: is this just a normal correction, or are we looking at the start of a full-blown crisis? Okay, just to wrap your head around how big this downturn really was, let's look at this number: $1 trillion. That is a staggering amount of money. That's the value that just vanished from the digital asset market in the last part of the year. We're not talking about a little dip here, folks. This was a straight-up collapse that wiped out a year's worth of gains for so many people. And that really leads us to the heart of what we're digging into today. The market was absolutely on fire. Bitcoin was hitting all-time highs. The vibe was just electric. So how in the world did it all fall apart so quickly? What on earth happened behind the scenes to trigger a collapse of that magnitude? All right, so to figure this out, we're going to tackle it in a few parts. We'll kick things off with the big global economic pressures, the macro headwinds that nobody could ignore. Then we'll dive into how different investors were reacting, because it's a fascinating story. After that, we'll unpack how Bitcoin's very identity seems to be changing. And finally, we'll put all the pieces together and see what the road ahead might look like. You know, for the longest time, one of the biggest selling points for crypto was this idea that it was its own universe, totally separate from the old school financial system. A hedge, right? Well, 2025 just blew that idea to smithereens. It became painfully crystal clear that crypto is now tied to the global economy, for better or for worse. And this quote from Rachel Lucas at BTC Markets, man, it just hits the nail on the head. She's basically saying, look, it's great that the political climate seemed pro-crypto, but good vibes don't pay the bills. Things like tariffs and monetary policy, those are the real heavyweights.
Macro forces, she says, matter way more than any political stance. And she was right.
Okay, look at this timeline. It shows just how fast the floor fell out. October 6th, Bitcoin's flying high, a new record of $126,000. Everyone's celebrating. Then, less than a week later, on October 12th, the US drops this bombshell tariff announcement on China, and the global markets just freak out. And the very next day, crypto gets hammered with the biggest liquidation event ever. 19 times $1 billion in 24 hours. And to top it all off, you had this tightening of global liquidity, partly from something called the yen carry trade unwinding. All you need to know is that it basically sucked a ton of money out of risky assets all over the world, and crypto was right in the firing line. Now, this is where things get really interesting. While the market was in a total freefall, a really clear divide started to show up. If you look at the data, you see two completely different stories, what the average person was doing and what the massive institutions were doing. It's like they were living in two different realities. And no surprise here, right? The overwhelming feeling in the market was just pure, unfiltered panic. The Fear and Greed Index, which is basically a mood ring for the market, cratered into extreme fear. This tells you everything. The sell-off wasn't just logical or based on fundamentals. It was a tidal wave of gut-wrenching, emotional selling. And you can see that panic in the actual numbers. The spot Bitcoin ETFs, which for a lot of people are the easiest on-ramp into crypto, saw a massive exodus. We're talking $5.5 times billion flowing out by the middle of December. That is a huge number, showing people were just rushing for the exits. But, and this is the big but, look at this. On one side, you have that retail panic, billions pouring out of ETFs. But on the other side, the big dogs, the institutional giants. While everyone was hitting the sell button, players like BlackRock were on a shopping spree. They scooped up over 1.3 million Bitcoin in just 12 days. Think about that. While regular investors were seeing a meltdown, the big institutions were seeing a Black Friday sale. And this wasn't just a one-off thing. Their long-term game plan is pretty obvious. A survey by State Street found that even though most of these big institutions still have tiny allocations to crypto, a huge chunk of them, 60%, are planning to increase that exposure over the next year. So they aren't just buying a little dip here and there. They're positioning themselves for a much, much bigger play, seeing crypto as key for diversification. So all of this, the way institutions are behaving, the way the market crashed, it points to something really fundamental changing. It's about what Bitcoin is now. That whole narrative of Bitcoin as digital gold, this safe haven asset that's totally separate from the stock market, yeah, the 2025 crash pretty much put that idea to rest. Instead, Bitcoin is now acting like a classic risk-on asset. So what does that mean? Simple. When the market's feeling good and investors are willing to take risks, it does great. But when things get scary and uncertain, it gets hit hard. And the most important part? Its price now moves right alongside the stock market, especially those big tech stocks. And hey, you don't have to take my word for it. Just look at the data. This chart is absolutely wild. It shows how closely Bitcoin's price has been moving with big stock indices like the S&P 500 and the NASDAQ. I mean, look at those lines. They're practically dancing together. Stocks go up, Bitcoin goes up. Stocks take a nosedive, Bitcoin follows them right down. This table really drives the point home. If you go back to 2018, there was basically zero correlation. Bitcoin was off in its own world. But fast forward to 2022 and 2024, wow, the correlation numbers shoot up, hitting almost 0.9 at one point. For anyone who deals with stats, you know that is an insanely strong connection. Bitcoin isn't an outsider anymore. It's plugged right into the mainstream system. So you might be asking, why is this happening? Well, a huge piece of the puzzle is public companies like MicroStrategy jumping into the game in a massive way. Just look at their holdings. They've piled billions into Bitcoin. What this does is it directly ties their company's stock price to Bitcoin's price. So now when people trade MicroStrategy stock, they're kind of trading a proxy for Bitcoin, and that literally weaves Bitcoin's ups and downs right into the fabric of the stock market. Okay, so we've looked at the global economy,
We've seen this split between different investors, and we've talked about Bitcoin's new identity. So, what now? What does all this chaos actually mean for the future of crypto? Where do we go from here? All right, let's just boil it all down to the key takeaways. First, crypto is absolutely 100% tied to the global economy now. Forget the island narrative. Second, we're seeing this massive split between retail investors selling out of fear and big institutions strategically buying for the long haul. Third, Bitcoin has changed. It's no longer digital gold, it's acting way more like a high growth, high risk tech stock. And finally, and this is a big one, maybe, just maybe, all this crazy volatility isn't a death sentence. Maybe it's just the growing pains of a new asset class finally getting integrated into the real financial world.
Look, things are changing in this space faster than ever before, and staying on top of these shifts is everything. That's what we try to do here. So if you get value out of this kind of deep dive, do us a favor and hit that like, share, and subscribe button for Crypto Explorer 24/7. It really helps us out.
And all of this leaves us with one massive lingering question. When we look back at the chaos of late 2025, what are we really seeing? Are we just watching the messy, chaotic, but totally necessary process of a brand new asset class growing up and finding its place? Or is this a giant, flashing red light, a warning of the huge systemic risks we're creating by weaving something so volatile into our entire global financial system? The answer to that? Well, it's going to define what comes next.